$40 billion just vanished from Tesla's valuation math, and your tech portfolio hasn't noticed yet. If you own Tesla directly, or hold it through an S&P 500 index fund, or 401k, a single pricing decision in China just changed the margin equation for your entire growth allocation. Here's why you need to watch this before earnings season hits in January. Buy $0. 12 per mile cost structure versus Tesla's $0. 18 isn't just competitive noise. It's proof that Tesla's 28-30% gross margins can't survive the next 18 months without compression. And when they compress, valuations reset down 20-30%. A $500,000 portfolio with 10% tech exposure loses $10, $000, $15, $000 in principal. By the end of this video, you'll know exactly how to audit your holdings and which 3 earnings scenarios determine whether Tesla reprices before or after you rebalance. Let's start with the margin math that Wall Street is underpricing. Tesla's current gross margin sits at 28-30% on automotive revenue. That's fortress-level profitability in a capital-intensive industry. The market prices this in. Tesla trades at roughly 50x forward earnings, a 200% premium to Detroit's 12x multiple. That premium exists because investors believe Tesla's cost structure and brand moat let it sustain 25% plus margins while competitors fight for 10-15%. Here's the problem. BYD's official 2024 manufacturing data shows a $0, 12 per mile cost of goods sold. Tesla's equivalent metric, $0, 18 per mile. That's a 33% cost disadvantage. Worse, BYD produces 1.6 million EVs annually at that cost. They've achieved scale. This isn't a one-time price dump. This is a structural cost advantage. Now here's where it gets worse for Tesla shareholders. Competitive pricing in China has already forced Tesla to drop prices 15-25% from 2023 highs. Bloomberg data shows Tesla's ASP, average selling price, in China fell from $55,000 in Q1 2023 to $38,000 by Q3 2024. That's a 31% haircut in 18 months. And BYD just announced further price cuts in December 2024. If Tesla matches pricing within the next 12-18 months, which China data suggests is inevitable, gross margins compress from 28-30% to 18-22%. That's a $40 billion DCF reset minimum. Consensus analyst models don't yet price this in. For your portfolio, here's the hidden risk. A household with $50,000 in Tesla exposure via direct shares or Vanguard's VOO, which holds 7% Tesla at current weights, faces this scenario. If Tesla's valuation multiple compresses from 50x to 35x forward earnings, a reasonable reset if margins drop 600 basis points, your $50,000 position loses $10, $000, $15, $000 in unrealized value. If dividend yield compresses because earnings growth slows alongside margin pressure, you lose another $3, $000, $5, $000 in annual income. That's $13, $000, $20, $000 of permanent portfolio drag on a single $50, $000 position. The timing matters enormously. Tesla reports Q4 2024 earnings in late January or early February 2025. That earnings call will signal whether management acknowledges margin pressure in forward guidance. If guidance reflects a 300-500 basis point margin reset, the repricing happens immediately. If guidance maintains 28% margins despite published BYD cost data, the repricing gets deferred 1-2 quarters and hits harder when it comes. Either way, now, before earnings, is when concentrated tech holders can rebalance into defensive sectors without chasing losses. Here's your 3-scenario decision tree. Scenario 1, Tesla guides margins down 300 plus basis points. Stock reprices 15-25% lower on earnings surprise. Scenario 2, Tesla guides flat but Q1 2025 data forces a reset by spring. Scenario 3, Tesla announces a manufacturing breakthrough that matches BYD's cost structure. Only Scenario 3 avoids the margin squeeze. The market is pricing Scenarios 1 and 2 at maybe 65% probability, yet positions reflect 10% probability. Your action: pull your latest 401k statement or brokerage holdings. Calculate your Tesla weight as a percentage of total portfolio. If it's 5% or higher and you're a dividend-focused investor, stress test a 20-25% price decline on that position. That's your principal at risk number. If losing that amount would force you to delay retirement or cut income goals, rebalancing now, before earnings, is worth the tax friction. If you can absorb it, hold and let earnings confirm the thesis. Markets reward the patient and the prepared.